Whether you're thinking about diving into big projects or sticking to smaller ones, which is still pretty big to be honest, both strategies can get you to that coveted Fiveplex mark, which ends up with better financing terms and can help you scale better in the long run. But which is actually better for you? Well, today we're going to break it all down, the pros, the cons, and everything in between to help you decide your next big move. But before we do, don't forget to like and subscribe for more tips on Toronto real estate investing. So here's the setup. We're assuming similar capital requirements for both projects, and I'll try to keep it simple and assume that you can borrow 80% on both capital and construction costs for both. So for the smaller project, you will need a higher down payment, but less for renovations. So approximately $1.5 million for the purchase and $500,000 for the renovations, with a total capital requirement of $400,000. The other project, the bigger one, would need a lower down payment since you really care more about just buying the lot, around $1 million for the purchase and another $1 million for the renovations because you are building. But again, $400,000 for the initial capital required for both combined based on an 80% loan to cost ratio. So financially, you are starting from the same place. Then, when both projects are complete, you should see similar cap rates based on the market value, which factors in the value add lift, and then you also end up getting similar appreciation rates moving forward. Now, here's where things differ. Smaller projects give you less lift, but they are more straightforward and carry less risk from a construction standpoint. And so, in this example, you can get approximately $500,000 of value add lift, but it could range between $400,000 to $600,000 depending on how well it's managed. Now, bigger projects promise higher lifts, around $1.1 million on average, but with a bigger range from $700,000 to $1.5 million, depending on how long it takes and how well it's managed. Which brings us to the next point. Timing is another big factor. Now, smaller projects usually wrap up in around a year or less, anywhere between 9 to 15 months, really. Bigger projects can take double the time. You can expect around 2 years to complete this, but it could range from 1 year to 3 years, depending on who manages it and how well it goes. Now, let's talk about returns as well. Absolute returns and returns on capital are better for bigger projects. However, once you factor in time, the difference doesn't get as big and the variability is way higher for bigger projects too. So what this means is that if things go off course, like if your construction costs go up or the project takes more time, your returns could actually end up being lower than a smaller project. And then there are other things to think about too. Bigger projects are usually harder to sell because of the bigger completion ticket price. The other thing to think about is refinancing, and this applies to those who are thinking about doing these projects with less than 5 units really, because refinancing can get trickier with larger projects. As your valuations increase with the bigger projects, qualifying based on your own income with residential mortgages becomes a lot tougher. Although, in our case, with the Fiveplexes, this could be solved with commercial residential mortgages like the CMHC MLI Select, which is basically the reason people are going to Five. But perhaps the main issue is that bigger projects mean cashing out double each time, which could actually be good and bad. So if you take a look at this chart, at year 5, you'll end up having to juggle 4 projects at the same time in order to maintain your growth rates, which can be resource intensive and increase variability if time management becomes an issue. Now, at the end of 7 years, both strategies could land you with 7 properties. Bigger projects lead to higher valuations per property and much better average returns, but they also mean more risk, more complexity, and more management challenges, which could actually make it tougher to accurately hit those better returns. So if you've got a lot of experience with big builds and you think you can hit those at least average case scenarios pretty reliably, then going with larger projects would actually make sense for you, since they do offer higher returns, and even better if you can't hit those best case scenarios. But for most investors, keeping things simple might actually be the way to go. Sticking to smaller projects can help you hit those targets more easily and make managing everything a lot less of a headache. So, are you curious about investing in Fiveplex projects in Toronto and you want to see our top picks? Well, let's just connect. We're a Toronto-based real estate sales brokerage that specializes in multiplex properties in Toronto. Whether you're aiming to buy a ready-to-rent property or you're looking to convert an existing house into a multiplex or even build your own, we've got experience to help you succeed. Here's how it's like to work with us. We'll get to know your goals, help you find great deals, and then eventually help you buy the best property for you. If you need renovations, we've got trusted contractors to help you out. Plus, we can handle renting and managing your property too. Ready to get started? Just head over to this link here and let's chat.